Have you ever had that trade that looked perfect? You're up big on gold. Maybe you're up 100 pips in your dollar and you start to think, this one's finally going to be my big win. I'm going to let it run. Then, just like that, the next session, it doesn't go more, pulls back. Half your profits have disappeared. And now you're watching the chart, whispering, no, screaming that I should have sold. Don't worry, we've all been there. I'm Lien with BKTraders, and in this video, I'm going to show you how to know exactly when to sell, how to recognize the signals that your winner is getting tired before the market takes your profits back. Now, 97% of people focus on getting into the trade, which is important, but if you're not protecting your profits when you get them, what's the point? Getting out is really what separates the traders who grow their accounts from traders who are stuck in the same loop. Most traders, they'll obsess over the entries, the perfect setup, the confluence, the confirmation, the trigger. But the exits, that's where emotions take over. You have greed, they'll tell you, oh, go higher. Ego, they'll say, you're right, don't mess this up. And hope that says maybe it'll come back after retracing against you. But the pros, they sell on evidence, not emotion. There's a golden rule that I follow, that your direction should be supported by the fundamentals. Your entry should be determined by the technicals. But when it comes to selling, to exiting, I sell based upon technicals alone, unless, of course, there's a huge news bomb. If there's a geopolitical headline, a trade tariff headline, unexpected rate cut, or surprise job reports that shakes the market, then sure, fundamentals have shifted and you need to adapt. But 95% of the time, the chart will warn you first. Price and volume always leaves clues before the headlines hit, because usually the insiders know something that you don't, or at least get a sense of it before the rest of the market does. Let's start with one of the clear signs that it's time to exit, the blow-off top, also known as the exhaustion top. A blow-off top is that euphoric final stage after a long uptrend. Let's say gold has been rallying for weeks, or eurodollar has been climbing every session, and then suddenly the price goes vertical. Traders, they feel invincible. Everyone's talking about it, and that's usually when the move's running out of gas. Here's what you'll see: a massive surge of 10 to 25% in a very short time. This isn't accumulation, it's exhaustion. You'll notice candles that are doubling in size, volatility exploding, and the market burning its last bit of fuel. That's actually exactly what we saw in gold in the month of October. We had a 12% jump in 10 days, 22% move in 5 weeks. Then we had the single biggest one-day candle of the entire move. That's your blowout bar. Huge rain, emotional buying, often near the very end. Then you have multiple exhaustion candles or runaway candles. On lower time frames, you may see those long one-way stretches with almost no pullback. That's panic buying. Price, when it stretches too far beyond the 200-day SMA, it should be on your red flag, especially when it's more than 100% beyond the 200-day. That tells you the market is exhausted. That doesn't mean short immediately, but it does mean tighten your stops, plan your exit, trail your stops. A hyped up catalyst like a rate rumor or a central bank speech, that kind of excitement often triggers the ends, not the beginning of a move. In this case, it was the prospect of a US-China trade truce. If you spot 2 or 3 of these technical signals, that's your signal to start scaling out, not adding more. Even if you miss the top, the market will still telegraph fatigue. It starts subtle, but once you know what you're looking for, you can start to feel the shift. And that could be in the form of heavy volume with doji consolidation candles that have no follow-through. I mean, for example, you'll see gold print a bullish candle, a strong volume. The next day, it barely moves higher or actually starts to move lower. That's called distribution. Big players are offloading into strength, while retail traders, they're trying to chase the move. If the candle looks powerful but doesn't go anywhere, take note. That's a stall, not a strength. Also, watch out for new highs with fading momentum. That's when you see price make a new higher high, but your momentum tools like RSI or MACD don't confirm it. You can see a classic example of this in this gold chart, where price makes a marginal new high, but RSI is already dropping lower. That divergence means the move's running out of energy. Doji or indecision candles at or around these highs, which we just talked about. You can see that here too, and you see multiples of examples of it in this gold chart. Those small candles with long wicks are the market's pause button. Buyers pushing price up, sellers shoving it right back down, and neither side is confident anymore. 1 or 2 dojis near key resistance levels around numbers, that's the market telling you we're getting tired up here. Also, you want to watch for repeated failures around round numbers of prior highs and lows. Like if eurodollar is testing 110 only to wick above and close below again, those levels usually attract a lot of liquidity. And when price can't clear it after multiple attempts, that's a ceiling. not a gateway. Then there's range contraction after expansion. When the candles suddenly shrink after a big move, that tells you the volatility is drying up. Think of it like a coiled spring losing tension. Once that energy is gone, the next big move is often down, not up. Spot a few of these clues together, and it's time to take partials, exits, or tighten your stop, because after this phase can oftentimes come the real breakdown. Now, let's talk about the moment the market actually flips, when that beautiful uptrend that you've been riding turns into a trap. That can oftentimes happen when you get closed below an important moving average, like the 50-period SMA on this chart, which is the blue line. You can see that when it fails to reclaim it, that's a problem. This is the single most objective signal that the tide has turned. Strong trends, they often live and die by the 50 SMA. When price closes above it and can't bounce back the next session, it means sellers have control. On a shorter term basis, I actually like to use a 20-day SMA, which is the yellow line. Below that, you have to consider getting out if the price drops below it. Of course, the biggest one-day drop in the entire run, this is the uh-oh candle. Long red candle, heavy volume, closing near the lows. That's a sign of panic selling, not a healthy dip. And it typically will be a dip that lasts for multiple days in a single move. And if you zoom in, you can see either aggressive delta or tick volume shifts confirming the distribution. Also, watch for trend line breaks and failed retest. Draw a line under the swing lows. When it breaks and prices pull back and then test that level again and rejects it, that's confirmation that the trend is over. Buyers tried to sell and take control again, but they failed. From there, every bounce should be seen as a selling opportunity and you should be out of your long trade. Watch also for the change in rhythm. This is what's subtle, but it's important. When your trend starts making higher highs and higher lows and then suddenly starts to make lower highs, even if the lows hold, that shows you the tempo is changing. It's like the market's heartbeat slowing down before the drop. That's when you want to lock in before the structure collapses. When you see these, don't overthink it. That's your cue to sell. Scale out or trail tight, not wait and see. Now, let's talk about how I actually manage my exits. I scale out in stages. When I see exhaustion clues like dojis, fading momentum, or resistance rejections, I don't dump everything. I'll take half off, move my stop, and let the rest run. That way, I protect my profits, but still stay in the trend in case it becomes a new leg. I like to trail by the 20-day SMA or the 8 EMA on a short-term basis. These are my personal favorites. You'll have your own. If the markets are trending cleanly, I use the 20 SMA as a dynamic trailing stop. Keeps me in for the bulk of the move, but also gets me out early enough when the momentum fades. When gold's trending above the 20 SMA, I'm holding. Once we close below it, I'm out. It's mechanical, clean, and keeps emotion out of the process. You can set alerts on your computer to do the work for you, and that way your emotions won't come into play. Don't stare at charts all day. Set alerts for when the price closes below your moving averages or the trend line. Let the system remind you, not the nerves. I recommend actually journaling every exit. After each trade, write, why did you sell? Did you see divergence, a doji, or a 20 SMA? That record sharpens your instinct over time. Detach after you sell. Step away from the computer. Once you're out, don't torture yourself watching what happens next. If price goes higher, fine, you made money. If it drops, even better. You play defense like a pro. Traders who last don't aim for perfection. They aim for consistency. Amateurs hold because of hope. They hope for more. Pros, they sell once they see the technicals shift, and technicals tell them when the move is done. Your job isn't to call the top. It's to keep your profits once you've got them. That's the only thing that you should be doing. And when you start to see momentum fade, like a close below the 20 moving average, that's not noise, that's your exit map. When you start to see dojis, start to think about the fact that there's weakness, not strength. And that's when you want to exit your trade. That's how you trade and think like a professional. So next time you're sitting on a great gold or currency winner and that voice says just a little bit more, pause and ask yourself, are the technicals confirming that, or is it just my emotion? Because the market always tells the truth. You just have to listen. If this video helped you, drop a comment below about the hardest part for you when it comes to exiting your trade and determining your exits, because maybe I can do a video for you on that. And if you want to take your trading further to the next level, make sure you subscribe and join our free trading community. The link is in the description of the video. And check out our curated list of prop firm and brokers below. We've done the due diligence for you and scoped out these firms. Now remember, buy in fundamentals and technicals, sell on technicals, unless the world just dropped a news bomb. Lock in your profits, protect your edge, and don't let the market take back what you've already earned.